Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the weeks ahead. Today, I'm joined by none other than our US co-head of G10 FX strategy, Brian Daingerfield. It is the perfect week for Brian to join us because we have seen some stellar US data. Despite all the Fed's aggressive tightening cycle, the US economy just doesn't seem capable of slowing down. We've seen US yields reach new highs for 2023, and the dollar is being dragged along with it, having repercussions across global FX markets. Brian, what are you making of these moves in US yields, and what do you think the implication is for the US dollar?
Yeah, sure. Thank you very much for having me, Eimear. So as you mentioned, US yields have moved higher, and now we've broken to the top side of the range. In fact, we're at year highs in a number of curve points after some very strong data. Now we're recording on Thursday ahead of the non-farm payroll report and ahead of a couple of other important data points that the Fed will have to consider. But independently of not just today's banner session, ADP stronger than expected, ISM services stronger than expected, we've also had, generally speaking, activity data has been quite a bit stronger over the last few weeks. If you look at economic surprise indexes, for example, we try and measure the scale of data results relative to market expectations. Those have been pushing higher over the last couple of weeks because you've really seen pretty consistent upward surprises in a number of cases in US economic data. And really, you have seen US yields have been pushing higher. That's really been a theme over the last month or so. We're up over 100 basis points now in the 2-year yield since the beginning of May. And a lot of that has come because of stronger data. But when you look across FX, especially in the G10 space, dollar moves have been relatively contained. And I think it's important that you sort of bring in the overall context that US yields have been rising, but global yields have been rising alongside the dollar yields in most cases. So we're not just looking at strong labor markets and higher rates in the United States. We're also looking at strong activity data and hawkish central bank decisions really across the G10. So you have big rises in front-end yields across economies. I mean, the United Kingdom is probably the one that stands out most, right? Where you have stronger than expected data on the labor market and unacceptably high inflation, forcing the Bank of England into a 50 basis point rate hike at their last meeting. So we have seen this US economic data have improved, US rates have risen, but that's not something that's happening in a vacuum. We're not talking about the US being the only economy facing these pressures. And for FX markets, we know that everything is relative. And so the fact that you're seeing a lot of these economies moving in this direction at the same time is certainly in the G10 space has kind of limited the dollar move. So if you look at the dollar index, you're relatively stable throughout this period of rising rates. But when you think about the dollar and the outlook going ahead, our outlook has been on the dovish side as regards to the US economy and to the Fed. But these data have been very consistently surprising to the top side. And certainly that presents a challenge to that view.
Yeah, I think that's a really good point that in FX, it's not just about the yields, it's about yield differentials, and they're the driving factors. And you make such a good point about the extent of the moves we've seen in US yields, but actually relatively stable or a lot more muted in the dollar. I guess looking ahead, what do you think are kind of the key points to watch out for and what the market's really going to be zoning in on when it comes to the dollar?
So I think it really is going to come down to this data because it's so important for the Fed outlook. Not just the data on the activity front, but also on the inflation side. I think it's really important to differentiate that a lot of the inflation data that we have seen has not been as strong as the activity data. If you look at the ISM services data that was released on Thursday, for example, the overall activity portions of that index were quite a bit stronger than expected. But the prices paid component, which is a bit more linked to prices seen and prices paid by businesses, that actually continued to come down. And I think as we look through the upcoming inflation data, the CPI, and also the non-farm payroll that you'll have all seen by the time you have heard this recording, it's important to consider the difference between activity data and inflation data, because if you're in an environment where activity data is performing pretty well, but the actual inflation data is not accelerating meaningfully, that could actually be a pretty positive environment for risk assets, if that is the type of environment that can prevail. But I think the way the market is looking at this activity and the way that rates are reacting is that activity data being strong increases future risks for inflation, that the risks to inflation may continue to be on the upside, and that central banks globally are going to have to respond to that. And so you've seen these higher yields. So far, you have seen equity markets, for example, have been trading pretty resiliently through these higher yields. That's something that's going to be important to watch as well, because for the US and FX markets, it's not just about rates. It's also about the broader risk picture and the broader growth outlook, that, if you're in an environment where growth can continue to perform, that could be one that could be more conducive to kind of a soft landing type environment. But you have these higher rates propelling weaker growth expectations, especially outside of the US. That could be an environment where the dollar performs better. So certainly for the dollar, I think it'll be key to watch the upcoming data, not just for the Fed, but also looking across the global spectrum. Is, do we have an environment where the US is accelerating while the rest of the world is moderating or slowing? Because that's the type of environment in which the dollar tends to do pretty well.
That's a great point that, inflation is coming lower, and perhaps not as fast as the Fed or even markets want, but, eventually rates market have to reprice in terms of central bank action. And I know you've just come back from Asia and are very jet lagged, and you have to tell us what were Asian investors thinking about the US economy and the dollar when you spoke to them?
I think a lot of investors, we met with a lot of investors before some of this recent economic data surprised pretty consistently to the top side. And there were a lot of expectations that data would continue to be solid. I mean, a lot of people pointing to the labor market and saying that this strong labor market is likely to continue to propel the US into a pretty strong backdrop. And I think a lot we're looking for the Fed to continue hiking and essentially looking at interest rates and interest rate differentials and seeing an environment where that was still pretty conducive to carry currencies generally, looking at high interest rates as really a driver of outperformance in a lot of cases. And especially in Asia, as you know, Eimear, it's a region where in emerging markets, those economies in Asia tend to have lower yields. And so that region generally was sort of disfavored for that reason. China was a particularly interesting point because, talking about carry currencies, cutting the policy rate in China and low interest rates is a pretty big point of contention and a potential point of weakness for the Chinese currency that I certainly noted during my discussions in region. So I think the outlook for the US and US dollar in region did lean on the bullish side. I think there were concerns kind of on both sides of what we call the dollar smile. If you think about if economic data turns poorly, if the global growth were to slow, you've already seen slowing expectations in China, for example. Those slowing expectations, those could boost the dollar in kind of a risk-off environment. Then there were also concerns in the other direction that if the data are too strong, that if the US data remain very strong, that could also keep the dollar supported. So I think the balance of opinions, when you take that together, leaned positive for the dollar on net.
Yeah, and I think it's a really good point that you mentioned that Asian investors were actually, quite optimistic on the dollar. They saw a number of reasons why it could continue to perform. But at the same time, they thought that carry, EM, high carry, could also perform. And that's kind of been one of our, highest convictions and best calls, is that we continue to think that, in places like LATAM, which offer you just, historically lucrative carry, BRL and Max still have higher to go despite very stretched kind of valuations. And in my region, I'm looking at the Czech koruna, the Polish zloty, where I think they've got high carry. They're underpinned by strong domestic fundamentals. We've seen a correction in current account deficits that blew out last year when you have higher energy import costs, and you have relatively limited political risk there as well. A caveat with saying that, Huff, that was probably the high carry favor of this year, is probably a little bit more at risk given kind of political considerations and fiscal risk, and it's probably quite stretched. But Brian, thank you so much for joining us today and taking us through some stellar US data and just the different dynamics which are really pulling the dollar at the moment. Guys, that's it for us today. If you did like the podcast, please do click like and remember to subscribe so you can get the latest episode first. Thanks again.